The world looks broken. Not slightly damaged, not temporarily unstable, broken at its core. Prices rise every month, but salaries don't. Governments speak the language of growth while borrowing unimaginable amounts just to keep functioning. Wars stretch on without resolution, becoming background noise instead of emergencies. Trust in institutions has evaporated so slowly that most people barely noticed it happening. What they notice instead is exhaustion, emotional, financial, psychological exhaustion. People feel poorer even when they work harder, angrier even when they stay silent, more uncertain even during so-called recoveries. By every rule taught in old economics textbooks, this should be the moment when markets collapse. Demand is weak, debt is extreme, inequality is historic, confidence is fragile. This should be the crash everyone warned about, the reset, the reckoning, and yet the stock market refuses to fall. It keeps climbing. It keeps recovering. It keeps acting as if none of this matters. That contradiction is not random. It is not luck. It is not resilience. It is the most important signal in the modern financial world. And it is the one most people are encouraged not to question. For most of history, the stock market behaved like a mirror. When businesses struggled, markets fell. When people stopped spending, companies suffered, and stock prices reflected that pain. Fear ruled markets because fear was rational. Confidence mattered because it could disappear quickly. When something broke in the economy, prices responded almost immediately. Pain showed up honestly, sometimes brutally, but clearly. That relationship no longer exists. Somewhere along the way, the stock market stopped reacting to reality and started reacting to power. It stopped asking whether the economy was healthy and started asking a different question, a far more dangerous one. Who will step in if this breaks? That single question has reshaped everything. Today, markets do not price risk the way they used to. They price expectation. Not expectation of growth, innovation, or productivity, but expectation of rescue. Whenever something goes wrong, the pattern is now familiar enough to feel routine. A shock appears. Panic spreads. Headlines scream crisis. And then, almost on cue, central banks move. Interest rates are cut. Liquidity is injected. Emergency facilities are announced. Balance sheets expand. Money floods the system. Markets rebound. Each rescue reinforces the same lesson. Falling markets will not be allowed to fall for long. Over time, that lesson changes behavior at a fundamental level. Fear fades. Risk feels manageable. Volatility becomes something to trade, not something to fear. Crashes no longer look like warnings. They look like opportunities. Every drop becomes a buying moment. Every crisis becomes bullish. The market is trained, slowly and consistently, to believe that pain is temporary, but support is permanent. This is not capitalism as it once existed. This is managed survival. The market now behaves less like an ecosystem and more like a protected structure, like a child learning to walk with a parent always nearby, ready to catch them before they hit the ground. And just like that child, the market learns something dangerous. Falling does not hurt anymore. Consequences feel distant. Gravity feels optional. But support always comes from somewhere. Money does not appear magically without cost. It is created through debt, through balance sheets, through policies that push consequences forward in time. At first, those consequences are almost invisible. Inflation creeps instead of explodes. Purchasing power erodes slowly enough that it feels personal, not systemic. Savings lose value quietly, year after year. People don't experience this as monetary policy. They experience it as stress, as anxiety, as the sense that no matter how hard they try, they are falling behind. The market is protected. Everyday life becomes heavier. This creates one of the strangest realities of the modern age. Asset prices rise while lived experience deteriorates. Stock charts look healthy while households feel fragile. Headlines celebrate record highs while ordinary people feel stuck. This disconnect is not accidental. It is the result of how modern money flows. When central banks inject liquidity, it does not spread evenly through society. It enters through financial institutions first. Banks, funds, corporations. Asset markets absorb the impact immediately. Stocks rise. Bonds stabilize. Real estate inflates. But wages lag. Small businesses struggle. Costs rise faster than incomes. The people closest to assets feel relief. The people closest to labor feel pressure. Ownership benefits first. Participation waits. This is why phrases like "the market is strong" feel almost insulting to many people. Their reality tells a different story. They are not confused. They are not ignorant. They are simply living in a system where the market no longer represents them. The stock market represents ownership, not work. Capital, not contribution. A small percentage of people own the majority of stocks, directly or indirectly. Their experience of the economy is fundamentally different. When layoffs happen, markets often rise because costs fall. When wages stagnate, profit margins improve. When efficiency increases at the expense of people, stock prices respond positively. Human pain is converted into financial performance. That is not a bug in the system. It is how the system now operates. The separation between the market and the economy is no longer emerging. It is complete. One can suffer while the other celebrates. One can decay while the other inflates. That is why the market can refuse to crash even when everything feels broken. It is not responding to social health. It is responding to financial engineering, policy design, and capital flows. Another layer of this illusion is where money is allowed to go. In a world of persistent inflation, holding cash becomes a guaranteed loss. Savings accounts fail to protect value. Bonds, once considered safe, no longer provide real security. That leaves investors with a narrowing set of choices. Stay in cash and lose purchasing power slowly, or move into risk assets and hope the system holds. For many, this is not optimism. It is coercion. Money is pushed into markets whether valuations make sense or not. Not because people believe prices are fair, but because alternatives feel worse. This creates crowded trades, overvalued assets, fragile stability. Markets stretch instead of fall. They inflate instead of correct. Reality is delayed, not denied. So when people ask why stocks keep going up, the answer is uncomfortable. Because they have become one of the last places to hide from inflation. That does not make them safe. It makes them congested. At the same time, technology has quietly transformed market behavior. Trading is no longer dominated by human judgment. Algorithms now control enormous portions of daily volume. Passive funds buy automatically, regardless of valuation or economic conditions. Retirement contributions flow in every month without emotion, without analysis, without pause. These systems do not feel fear. They follow rules. Many of those rules are built on assumptions formed during decades of intervention. That markets rise over time, that downturns are temporary, that support arrives when conditions worsen. Because these assumptions have been rewarded repeatedly, they have hardened into belief. And belief, once encoded into machines, becomes dangerous. When prices fall, systems buy. When volatility spikes, portfolios rebalance. Panic is absorbed before it spreads. The market looks calm even when pressure builds beneath the surface. Drops feel shallow. Recoveries feel fast, stability feels natural. But this stability is artificial. It exists because the system assumes the future will resemble the past. That central banks will intervene again. That governments will protect asset prices. That liquidity will always arrive in time. Foundations built on assumptions can look strong for a long time, until they aren't. Governments themselves have strong incentives to keep markets elevated. Pension systems depend on returns. Retirement accounts depend on growth. Political legitimacy is often tied to economic performance, and markets are used as visible proof that things are under control. A sustained crash would not just destroy wealth, it would expose policy limits, institutional weakness, unsustainable debt. Stability becomes a necessity, not a result. But protecting markets carries a hidden cost. Every rescue increases dependency. Every intervention teaches the system to take more risk. Resilience erodes quietly. Like a structure reinforced only at the surface, it appears solid until pressure builds underneath. The longer markets refuse to crash, The more people begin to believe that crashes are impossible, that belief changes behavior. It encourages leverage, justifies extreme valuations, normalizes inequality, and slowly drains trust from the real economy. People work harder and save less. They watch asset prices soar beyond reach. Home ownership drifts further away. Stability feels temporary. The future feels uncertain even during so-called good times. This damage does not show up on a stock chart, but it is real, and it accumulates. This is not strength. It is postponement. The market is not immune to reality. It is insulated from it, for now. And insulation does not remove pressure. It traps it. The longer pressure builds, the more unpredictable the release becomes. And this story is far from over.